expressed by the program participants are their own and do not reflect those of Blue Line Futures, LLC, or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures and options trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition. As a CTA, Blue Creek Capital may or may not hold positions in the assets discussed.
Hi, I'm Bill Baruch, and I'm here with my partner, Oliver Slope, and we're the founders of Blue Line Futures, an introducing broker, and Blue Creek Capital Management, a commodity trading advisor. And this is the new segment, Trade It or Fade It. Well, let's pick up where we left off last week with your wheat idea, where we saw some value there.
It was an idea, okay? Yeah. It hasn't really played out so far. We're basically trading around the same level that we were last Tuesday when we discussed this trade, and we're talking about buying a call spread strategy that says 670, 725 strike is what we're looking at. I think we quoted it around 11 cents that day. Still trading at 11 cents. And the price is about the same as well, which I think all in all is actually a positive development, I guess you could say, because we have had a little bit of time decay.
Yeah, and you had a lot of good reasons of why to position in this wheat trade ahead of the WASDE report. You mentioned the commitment of traders. You mentioned the fundamentals. Sometimes, though, when you position ahead of an event like that, there is obviously premium built into an option spread, and that's why using a call spread where you're also selling a leg against the long leg can take away some of that cost, some of that volatility you're paying for. And speaking of volatility, the CVOL, which can be found on the CME's website, simply you can Google CME CVOL and you can get to that page. Wheat CVOL, pricing that implied volatility index, has been actually the highest level since November. But what I did notice is it's actually continued to grind higher after the WASDE report, which I think is actually a good sign here for those options holding value.
Yeah, I think so too, and I'm happy to see that because it's making up for that time decay. You're seeing the premium stay in the market, and typically after a USDA WASDE report, you get what's often referred to as a vol smash, right? And the premiums come way down, and those options kind of go worthless. But as you'd mentioned, making it into a call spread, you got that short leg against it. But the other catalyst behind the call spread wasn't just the WASDE report. It's looking past that to this week's Black Sea grain deal deadline, which is May 18th. And I think that's part of the reason why we're seeing the volatility remain elevated at these levels. So I still like it. And again, the call spread, it was one of those trades where you know what the defined risk is, and you don't have to be right now. There's still over a month of time on that. So still plenty of time for things to pan out. And the fund's still holding one of their largest net short positions in over 5 years.
That's great. Yeah, and I'm excited for that. I'm we're in that position in something similar in the Blue Creek program. So, I think there's definitely some upside here with wheat. I do agree with you. Let's shift gears, though, and let's just focus the rest of this segment here today on gold. I mean, everybody's watching the precious metals. It's been a number of factors being priced into, moving the volatility around here for gold. It finished pretty poorly today, one of the lowest levels since I think the start of May, first day of May, end of April, right down at 1990 to 1994 is what we're trading at the end of the session here today. So again, a number of factors. First, you got copper and silver rolling over last week after the China deflation or disinflation data. Then we had new loans data that were eroded, and then it played into what does the U.S. dollar do? And right. We've seen some euro weakness, we've seen some yen weakness this week, and as the U.S. dollar strengthens against those two currencies, it can weigh on gold. Additionally, if you look at the euro, the euro is really only at several week lows right now after today. But the Chinese yuan, which is a tradable future on the CME, that right there has hit the U.S. dollar strengthened to the highest level since the first week of March against the Chinese yuan. So if you're trading metals, you have to know where the Chinese yuan is trading. They consume 50% of the world's copper. They're big players in the gold market. I mean, they're one of the biggest central banks buying gold throughout the last year. So I think you got to pay attention to that. And again, gold is now the last little chip to fall here after copper, after silver. Now gold has. So it puts it on its back leg. What are your thoughts on gold here and how it's setting up?
Well, I like gold, but I'm a little bit nervous that we could see a little bit more downward pressure here in the very near term. It almost seems like we got that blow off of top. What was it, about 2 weeks ago, where we spiked up to 2080, and we just weren't able to get that momentum to carry forward. Now we're pulling back, testing that psychologically significant $2,000 and trading below it today, which makes me nervous that we weren't able to defend that, and a little bit skeptical. But we are towards the low end of the range in the 50-day moving average near 1990. So I think for me, looking at it from a technical standpoint, it's kind of a must-hold area.
Yeah, that 50-day moving average is pretty big. And I'll get to some of the levels below there in a second. But one of the things I'm watching very closely is really building into the narrative. I mentioned the currencies for some of those reasons, global growth fears. But the U.S. dollar can then be a safe haven kind of due to those fears. The economic data has not been great. We've seen some deterioration there. Retail sales was not good either. New York Empire State Manufacturing was poor yesterday, but that kind of builds in a safe haven bid in the U.S. dollar right now. As gears shift in focus to, we get to the debt ceiling talks, it's going to be the Fed meeting. That is the middle of June. And the odds for the Fed to hike rates again in June, I just think they're underpriced right now. You're right at a 21% probability to see a 25% hike, 25 basis point hike in that June meeting. That can be seen. The Fed watch tool, the CME's Fed watch tool, calculates the probabilities using Fed funds futures, and that can be found on their website as well. I look at this as one of the first things I look at every single day. Additionally, you go out through year end, you have the odds of a rate cut, pricing in 50 basis points of rate cuts. We've been hearing all these Fed speakers last week and this week, coming out of that meeting, they're saying no cuts. So the market could be a little offsides here, even if it's right now, even if it ends up playing out where they don't hike and then we do see 50 basis points of cuts before the end of the year, the probabilities may be a little offsides. So that gets me thinking that the U.S. dollar can continue to strengthen against the euro and the yen and the yuan, just given the macro environment. But again, 50-day moving average there in gold. What I'm also seeing is if that 50-day moving average breaks, 1980's been a floor. Below there, I see some support between 1955 area, which we could hit next. The big level, though, if 1980 really is surrendered and there's no real fundamental catalyst to snap it back, we're likely on the path potentially to somewhere 1925, 1930. That's what I'm seeing. What are you seeing in your technical
work?
work?
Pulling that up from trend line support from those October, November lows. We tested, held it in March, and that's where that trend line comes in, which also coincides with the 100-day moving average. So I go back to it, the 1990, 1980 area is kind of a must-hold last line of defense for me, break and close below there. And, look out below potentially.
Yeah, you got that triple top, and we got there's a triple bottom in a very short period of time coming through October, November. Triple top that we had it goes back to 2020. So what I'm looking at is that range from the November low all the way up to the recent high, and the 382 retracement back down comes in right there at that pocket too, 1920, 1930. There's a lot of levels aligning there, and I always look at the 382 retracement. If something's in an uptrend and it comes back and it holds that 382, and it may not even get to the 382, could show even more strength if it doesn't quite get there, which would be a good sign. So if something is in an uptrend, it holds that 382 and then continues the uptrend, similar to a downtrend. If the market's in a downtrend and then rebounds up to the 382 retracement back up and then starts selling off again, it remains in a downtrend. So that's something I'm going to be watching very closely. As these odds move, the dollar has a presence within the gold trade. What happens here in the next week? Maybe we hold 1980 and we're back above, right back in the thick of unchanged in the week. We don't know. And that's where patience really pays right here. What I'm also seeing is the CME's CVOL tool on gold. Some of that CVOL's coming in, and I mean, heck, we're still though well off those March lows. Though the March premium that was in it when the banking crisis has eroded a bit. But if we sell off a little bit, the options are going to get super cheap, and that's where I think the real the opportunity lies within that. If we were at a price today that I wanted to buy gold, I'm looking at even the 2030, 2080 August spread. Now, I would shift that spread down the lower we go, hoping it costs less to put into sort of relevance on how much I'd want to pay. That 2030, 2080 call spread for August right now costs $16. I would not want to pay more than $12 on something like that. However, again, if gold continues to trade lower, it's all about patience here. I'm going to be patient. I want to see if gold starts breaking some of these levels. I mean, who knows? Maybe it gets down there 1930. I would shift that spread down, give myself a $50 wide spread, and look for the cost roughly around $12 going out to August for a rebound.
I like that trade set up a lot. I think patience is obviously key. And as mentioned with the wheat and the call spreads are a great way to give you some staying power in the market. Sounds like a great risk-reward ratio. So, yeah, it'll be interesting to see what the gold market does here to round out the week and see if that 50-day moving average can hold.
Yeah, I mean, it's Tuesday right now. We had the China data last night. We'll see how gold trades tonight in reaction to a lower finish today. That's what we're looking at. You can trade it or fade it. It's good.